Hello friends, this class is in the continuation of our previous class. In this class and in the previous class, in our previous class we are discussing about the section 45 means charging section. Scope and the time of chargeability means when the amount of capital gain, when the amount of profit or gain which is arise on the transfer of capital assets will be taxable. Means we are discussing charging section of capital gain, which is explain about the chargeability of income tax or chargeability of the tax under the head of capital gain. So in this case we have covered some points in our previous class. Now we will discuss some other important provision or some other important section and point in our class. So now we will start discussion. Compensation or compulsory acquisition is that if there is any person whose land or building is compulsory acquired by any person under any law, is that if there is any person who has any agriculture or any land, any building, he has any land and building, and such land and building is acquired by the government compulsorily. It is acquired by the government compulsorily, and he has received the amount of compensation, and in the consideration of such land and building he received the amount of compensation from the government. Then as per section 45 subsection 5, such amount of compensation will be taxable in the year in which such a compensation received. Means the capital gain which is arise on the transfer of such on the transfer of such or on the compulsory acquisition of such land and building will be taxable in the year in which the compensation received. Is that when there is any building or any other asset which is belonging to the person. If there is a person who has a building, he has a capital assets, and such capital assets or such building is acquired, is compulsorily acquired by the government. It is compulsorily acquired by the government, then the capital gain, then the amount of capital gain shall be taxable in the year in which compensation or the part of the compensation was received. Is that the amount of compensation will be the amount of profit or gain which is arise on the transfer of or on the compulsory acquisition of such property will be taxable in the year in which the amount of compensation was first received. For the example, there is Mr. Ram and he has a land. He has a land. Such a land is compulsorily acquired. It is compulsorily acquired by the government. And such assets is compulsorily acquired by the government and the compensation paid on 1st May 2020. The amount of compensation is paid on 1st May 2020, and the total compensation will be 15 lakh, but on 1st May 2020 they pay 5 lakh rupees. Okay, they pay 5 lakh rupees. The value of the land, or say the stamp duty value. The stamp duty value of the land, for the example, 10 lakh rupees. In this situation, the amount of capital gain will be sale consideration. Sale consideration is 15 lakh minus stamp duty value. Stamp duty value of such land, means in the case of immovable property, we will take stamp duty value or the cost of acquisition. We will take cost of acquisition. We will take cost of acquisition as 10 lakh rupees. Cost of acquisition for the example 10 lakh. So in this situation, the amount of profit will be 5 lakh rupees. The gain is 5 lakh and it will be taxable under the head of capital gain. Such amount of gain 5 lakh rupees will be taxable under the head of capital gain, and it will be taxable in the year when the compensation was first paid, whether it is full compensation or whether it is part compensation, but in the year in which the compensation paid in 20 and 21. So such amount will be taxable in the previous year 2020 and 21. Means such amount of capital gain 5 lakh rupees will be taxable in the year in which compensation received either in part or either in full. Means first time compensation will be received when such amount of capital gain will be taxable. So in the year 2020, Mr. Ram, he has received compensation 5 lakh rupees, means some part compensation he has received. So the capital gain will be taxable. The capital gain will be taxable. Such 5 lakh rupees will be taxable in the year in which compensation received. The compensation is received in the year 20 and 21. So such 5 lakh rupees will be taxable in the hands of Mr. Ram under the head of capital gain in the previous year 20 and 21. So what will be the concept in the case of enhanced compensation? In the case of enhanced compensation, what is the meaning of enhanced compensation is that, for the example, the compensation decided by government. For the example, it is a 25 lakh, but there is a dispute and they want to enhance the compensation. Means the person is that the ram want to enhance the amount of compensation. Means he is saying the 25 lakh rupees is the less amount. The compensation should be 35 lakh. It should be 35 lakh. So if such 35 lakh rupees is accepted, so in this case enhanced compensation will be 10 lakh rupees. So the 10 lakh rupees will be considered as enhanced compensation. Means the increased compensation will be known as enhanced compensation. So what will be the taxability in the respect of enhanced compensation? What will be the taxability in the respect of enhanced compensation? Is that many times the person whose capital assets has been taken by the central government and he get the amount of compensation as an enhanced compensation. Means he has received increased amount of compensation. If the court award a compensation which is higher than the original compensation, means if the such 35 lakh rupees is accepted by the court or if it is accepted by the government, then such 10 lakh rupees will be considered as enhanced compensation. And such a difference will be chargeable to tax. Such an amount of compensation, such amount of enhanced compensation shall be chargeable to tax under the head capital gain in the year in which it is received. Means such enhanced compensation will be taxable. It will be taxable in the year in which the same is received from the government. It is received when it is received from the government. So if the enhanced compensation received on 31st January 2021, then such amount will be taxable in the year in which it is received. Means it will be taxable in the previous year 2020 and 21. such a amount will be taxable, such a 10 lakh rupees will be taxable in the year in which it is received, Now we will discuss a example. Mr. Mohan, he has a building, and it is compulsorily acquired by the government. Such building is compulsorily acquired by the government. It is compulsorily acquired by the government. Compensation, compensation decided by the government. For the example, it is a 50 lakh. 50 lakh compensation is decided by the government. But Mohan is not satisfied. He wants more compensation. Means he wants more compensation. For the purpose of this, he make a appeal. Means he went to court to increase the amount of compensation. After some time, the compensation enhanced. Compensation decided by court. For the example, 75 lakh. Means it is decided by government. Means the compulsory acquisition taken place on 1st January 2020, and the compensation is decided on 1st January 2020. But it is decided on 31st March 2020. It is decided on 31st March 2020. Where such amount is decided, Mr. Mohan received 10 lakh rupees as compensation. As a compensation means he has received part compensation. And the balance compensation is received, and the balance compensation received on 28th Feb 2020, and the balance 25 lakh enhanced compensation. Enhanced compensation is received on 25th 4 2021. 25th 4 2020. It is received. So in this situation, in this case, first we will calculate capital gain. Compensation decided by the government. Compensation means compensation received. It is 50 lakh less cost of acquisition. For the example, it is 35 lakh. So the capital gain will be 15 lakh. It will be 15 lakh. It will be considered as capital gain, and it will be taxable in the year in which the amount of compensation is received, whether it is in part or whether it is in full. So it is received in, it is a compensation received in 1st January 2020. Means such 15 lakh capital gain will be taxable in the year 2019-20. Such amount of capital gain will be taxable in the year in which first amount of compensation received, whether it is a full compensation, whether it is a part compensation. So the capital gain will be taxable in the year when the part payment or when the full payment is received first time. So the first time it is received of 1st January 2020. Now this is the taxability of capital gain. Now we will discuss the enhanced compensation. So the enhanced compensation of rupees 25 lakh is taxable in the previous year 2020 and 21. Means when it is received. It is received on such a 25 lakh received on 25th It is received 25/04/20. So it will be taxable in the year in which it is received. It is received in the previous year 2020 and 21. So it will be taxable in the year 20 and 21. Means the capital gain will be taxable in the year when the first time amount of compensation is received. Is the amount of compensation received, and the enhanced compensation will be taxable in the year in which it is actually received. In the year in which the enhanced compensation is actually received. It is actually received. So the difference will be chargeable to capital gain in the year in which the same amount is received from the government, and it will be chargeable under the head of capital gain. It will be chargeable under the head of capital gain. Cost of acquisition in the case of enhanced compensation. What will be the cost of acquisition in the case of enhanced compensation? So for this purpose, the cost of acquisition and the cost of improvement shall be taken as nil. Means when there is any compulsory acquisition, when there is any compulsory acquisition, or there is the receive of amount of enhanced compensation, then the cost of acquisition will be zero. Is that when the such 25 lakh rupees is received, then how we will calculate capital gain? Because it will be taxable under the head of capital gain. It will be taxable under the head of capital gain. So how we will calculate capital gain? So the capital gain will be sale consideration means enhanced compensation. Enhanced compensation. It is 25 lakh less cost of acquisition. Less cost of acquisition, it will be zero. As per the provision, it will be zero. It will be zero. So in this situation, total 25 lakh will be taxable under the head of capital gain. It will be taxable under the head of capital gain in the year in which it is actually received. Compensation received in the pursuance of interim order deemed as income chargeable to tax in the year of final order. Is that when there is any amount of compensation received in the pursuance of any interim order, means the order is not final, it is the interim order. Is that if there is any compensation is received in the pursuance of interim order, then such compensation shall be taxable. Under the head of capital gain in the previous year when the final order from such court or from the tribunal or from the authority is made. Means if there is any amount of compensation, which is received in the respect of or in the pursuance of any interim order, then it will be considered or it will be deemed as income in the year. Such amount of compensation will be deemed as income in the year in which such order will be finalized. When such order is finalized by the court, by the tribunal, or by the any authority. Means when the order is finalized, then such amount of compensation will be taxable under the head of capital gain. Is that in order to remove the uncertainty regarding the year in which the amount of compensation received in the pursuance of an interim order of the court, then it will be chargeable to tax. In the year in which the final order of such court, the final order of the tribunal or any authority is made. Means such amount of compensation will be taxable in the year under the head of capital gain in the year in which the tribunal or the court made the final order. It is made the final order. For the example, Mr. Mohan, he has received compensation. In the respect of a interim in the respect of interim order. In the respect of interim order, the amount of compensation is 50 lakh. So the interim order is received in the previous year 1920. 1920 order finalized by the court in 2020 and 21. Then such compensation will be taxable under the head capital gain in the previous year 2020 and 21. Means in this year when order finalized by the court. When the order finalized by the court, then such amount of income will be taxable under the capital gain, under the head of capital gain. When the order is finalized by the assessee. When the order is finalized by the assessee. Reduction in enhanced compensation. When there is the reduction in enhanced compensation, is that there is the amount of compensation which is received by the assessee. The compensation is received by the assessee, and the compensation which is enhanced by the assessee is also received by the assessee. But after the certain time, the government or the court or tribunal reduce the amount of such enhanced compensation. It is reduce the amount of compensation. So in this situation, there is a requirement to recompute the amount of capital gain. Means there is the requirement to compute the amount which will be taxable under the head of capital gain. Means where the capital gain has been charged on the amount of compensation which is received by the assessee. Means the capital gain is a charge or it is taxable under the head of capital gain on the amount of compensation which is received by the assessee from the government on the compulsory acquisition of any capital assets. And the enhanced compensation is also taxed. The amount of enhanced compensation which is received by the assessor is also taxed in the year in which it is actually received. But subsequently, the court or the court wants to reduce the amount of enhanced compensation. The court wants to reduce the amount of enhanced compensation on which the tax is already paid. Means on which the capital gain is already calculated and the tax is already paid. So in this case, the recomputation shall require to be made. Mean the recomputation is required to be done by the way of rectification under section 55. Means recomputation is required to be done. The recomputation is required to be made of rectification under section 155. Means recomputation of the capital gain is required to be made, and it is made by the way of rectification under section 155. Under section 155. Death of the transfer. Now we will discuss death of the transfer. It is possible that the transferor may die before he receives the enhanced compensation. Is that there is a person, he has made a case to increase the amount of compensation. But before receive the amount of enhanced compensation, he may die. He may die. So in this case, the amount of enhanced compensation will be chargeable to tax in the hands of the person who received the same. Means the amount of enhanced compensation will be taxable in the hands of the person who will receive the amount of such compensation. Is that if the legal representative of such person receive the amount of compensation, then the legal representative, they will be liable to make the payment of tax on such amount of enhanced compensation. Means it will be such amount of enhanced compensation will be taxable in the hands of legal representative, in the hands of any authorized person after the death of the person, after the death of the transfer. Now we will discuss taxability of capital gain in the case of specific agreement. What will be the taxability if the capital gain is arise in the case of special agreement? In the case of a special agreement, if the capital gain is arise, then what will be the taxability? Then what will be the taxability? So there is a genuine hardship on the account of taxability of the capital gain in the year of transfer of property to the developer. Is that when, as per the normal provision of the capital gain, the capital gain will be taxable in the year in which the transfer taken place. In which the transfer taken place. The transfer includes any arrangement. The definition of the transfer includes any arrangement or transaction where any rights are handed over in the execution of part performance of contract. Is that if there is any right which is handed over in the execution of part payment of a contract, then it will be considered as a transfer. Then it will be considered as a transfer. Even legal title has not been transferred, but has not been transferred, but it will be considered as transfer. Means the definition of the transfer include that if there is any arrangement or there is any transaction where the rights are handed over, where the rights are handed over in the execution of part performance of contract, then it will be considered as transfer, even though the legal title has not been transferred. So, applying the definition of transfer under these development agreement, the transfer took place in the year in which the owner of the immovable property, means the owner of land and building or the boat, hand over the immovable property to a developer. Is that on the basis of such a provision, the capital gain, means the profit or the gain which is arising on the such transfer, shall be taxable in the year. It shall be taxable in the year in which the immovable property handover to the developer. Means in the case of development agreement, under the development agreement, the transfer taken place in the year in which the owner of the immovable property transfer the immovable property to the developer. Means the taxability of the capital gain will be arise in the year when the immovable property is transferred by the owner to the developer. In the year when the immovable property is transferred by the owner to the developer. Is that, for the example, there is a development agreement. There is a development agreement. There is a development agreement between the there is a development agreement, and on the basis of such development agreement, there is a development agreement, and in such development agreement, owner of the property transfer the such immovable property to development, to such a development. In the case of development, agreement, the owner of the immovable property, it is immovable property, in the owner of the immovable property transfer such immovable property to the developer for the in the previous year 2019 and 20. In the previous year 2019 and 20. So in this situation, on the date of transfer, on the date of such a transfer, it will be considered as transfer. Means when the owner of the immovable property transfer the property to the developer for the purpose of development agreement. On the development agreement, then it will be considered as transfer. Then it will be considered as a transfer, and provision of capital gain will be applicable. The provision of capital gain will be applicable, and the capital gain will be taxable in the year in which in which the owner transfer such immovable property to the developer. Means such capital gain will be taxable in the year in which the owner transfers such immovable property to the developer. Means it will be taxable in the year 2019-20, because the transfer taken place in 2019-20. So such capital gain, if there is any capital gain is arise on such a transfer, then it will be taxable in the year. Then it will be taxable in the year in which the owner of such immovable property transfer such immovable property to the developer under the Development Act. So consequently, the capital gain tax liability in the hands of owner would be arise in the year in which the possession of the immovable property is handed over by the owner to the developer for the purpose of development. In spite of fact that consideration therefore will be received after the couples of year, the amount of compensation will be received, but it will be taxable in the year in which the property is handed over to the developer for the purpose of development. Deferment of taxability of capital gain. Deferment of the taxability of the capital gain, with the view to minimize the genuine hardship which the owner of the land or property, land and building may face in paying the capital gain in the year of transfer. Normally, as per the provision of the capital gain, the amount of the gain which will be taxable in the year when the transfer taken place. And as per the section 45, subsection 5, as per the section 45, the transfer means the amount of the capital gain will be taxable in the year in which the transfer taken place. But the section 45 subsection 5A provides that section 45 subsection 5A provide, and it is contained the provision in the respect of deferment of capital gain. Means we can defer the amount of capital gain. So section 45 subsection 5 provides that. Section 45 subsection 5A subsection 5A provides that number 1, in the case of assessee who is the individual and HUF. Number 1, the assessee is individual or HUF who entered into a specific agreement for the development of project. Is that if there is any person who is the individual or who is the HUF. If there is a person who is the individual or HUF and he entered into an agreement, and such person entered into a specific agreement for the development of project, then the capital gain which is arise on such a transfer, the capital gain arise on such a transfer shall be chargeable to tax as income in the previous year in which the certificate of the completion for the whole or part of the project is issued by the competent authority. Is that the capital gain, the amount of capital gain will be taxable in the year in which the certificate of the completion for the whole or for the part of the project is issued by the competent authority. Means when it is issued by the competent authority, then the amount of capital gain will be taxable in the year in which the certificate of the completion has been issued. The certificate for the completion has been issued. For the example, there is a Mr. A. He is an individual. He is an individual, and he entered into a development. He entered into a development agreement. He entered into a development agreement. He entered into a development agreement. So in this case, the capital gain means it will be considered as a transfer. In this situation, the capital gain, in this case, the amount of capital gain will be taxable in the year in which the certificate of completion is received. Such certificate, whether for full completion or whether for part completion, when it is received, such amount of capital gain will be taxable. Such amount of capital gain will be taxable. For the example, Mr. B, he is an individual, and he entered into a development agreement, and it will be considered as transfer, and there is the amount of capital gain. For the example, 25 lakh. There is the amount of capital gain is 25 lakh. Such amount of and completion certificate is received in the year 2018 and 2019. It is received in 2018 and 2019. Then such capital gain of rupees 25 lakh will be taxable in the 2018 and 2019. Because the letter of completion is received in 2018-19, so it will be taxable in the year when the completion letter is received. So the completion letter is received in 2018-19, so such amount of capital gain will be taxable in the year when the completion letter is received, whether for the full completion or whether for the part completion. But when the completion letter is received from the authorized person or from the authorized authority, then the amount of capital gain will be taxable. Meaning of specified agreement. What is the meaning of specified agreement? Specified agreement means a registered agreement in which a person owning a land or building or both, and he agrees to allow another person to develop a real estate project on such land or building. He said a specific agreement means a agreement. The specific agreement, it is a registered agreement, and it is made between the person. It is made between the person and the owner of the land and the owner of the building or both. He will provide or he will allow the person to develop the real estate project on such land or on such building. Means he provide the right to develop project the real estate project on such land or building in the consideration. Means he will, in the respect of this, he will receive the amount of consideration in the consideration of the share being land or building or both in such project, whether with or without the payment of part payment or the payment in consideration. Means there is a person A. He has a land. He allow B to develop to develop real estate on such land. Means he allow to develop a real estate building or the real estate on such land. But he will receive 10 flats in such building, he will receive 10 flat in such building and 50 lakh rupees, 50 lakh rupees in the consideration of such right, or in the consideration of such allowance. So this agreement, so the agreement which is made between A and B will be considered as specified agreement. Specified agreement. It will be considered as specified agreement. So, specified agreement means the registered agreement in which the person who has owning the land and building, means A, agree to allow B to develop the real estate project on such land and building. In the consideration of the share, means he ask, or he will receive 10 flats in the building, or 15 lakh rupees, and 15 lakh rupees for the purpose of such allowance. So this agreement will be known as specified agreement. Specified agreement. So what will be the full value of consideration? What will be the full value of consideration in the respect of this? So for the purpose of section 48, the stamp duty value of such share, being land and building or both in the project on the date of issuing the said certificate of the completion, as increased by any compensation which is received in cash, means first we will discuss the stamp duty value, of these flats, and such 50 lakh rupees, will be considered as full value of consideration. Means the stamp duty value of these 10 lakh 10 share, for the example, the for first, means the stamp duty value is 25 lakh rupees, per flat. So the total amount will be 25 into 25 lakh into 10. 25 lakh rupees into 10 plus 50 lakh. So the total will be 30 lakh rupees. 3 crore rupees. Total cost of, full value of consideration. This is the value of consideration. The value of consideration will be 3 crore rupees. If any shall be deemed to be the full value of consideration which is received or accruing as a result of transfer of such capital assets. So the full value of consideration on the basis of such example is 3 crore rupees. Means for the purpose of this, we will determine the stamp duty value of the building, or the immovable property which is provided in the consideration of such a right, or if there is any consideration which is received in cash, it will also be add to calculate the full value of consideration. Non-applicability of the beneficial provision. Now, we will discuss when the beneficial provision will not be applicable. Is that when such a provision will not be applicable. Such provision will not be applicable when the assessee transfer his share. When the assessee transfer his share in the project to the any other person on or before the completion certificate. Is that when there is the person, he transfer his right or transfer his share in such project on or before the date of issue of completion certificate, then such a beneficial provision will not be applicable on him, and the capital gain will be taxable in the year in which the transfer taken place. Is that, for the example, here Mr. A received these 10 flats A receive 10 flats, 10 flats. He transfer these 10 flats. He transfer these 10 flats to another person before before the before the issue of completion certificate. Before the issue of completion certificate, he has issued these 10 flats. He has issued these 10 flats to the another person. So in this situation, the amount of capital gain. So in this situation, the amount of capital gain will be taxable. It will be taxable in the year in which transfer taken place. Means the benefit, such benefit will not be available, means the benefit to the benefit that the capital gain will be taxable in the year when the completion certificate is received. But if these flats are transferred by the assessee before the issue of completion letter, before the issue of completion certificate, then such benefit will not be available. Is that in this situation, the capital gain will be taxable in the year in which the transfer taken place, So it may however, it may, however, be noted that these beneficial provision would not apply. These beneficial provision would not apply where the assessee transfer his share in the project on or before the date of issue of said completion certificate. And in this situation, the capital gain shall be arise in the year in which the transfer taken place. If he transfer his right or he transfer his share in the project to the any other person before the issue of completion certificate, then the amount of the capital gain on such transfer will be taxable in the year in which the transfer taken place. In such a case, full value of consideration received or accruing shall be determined by the general provision, means on the basis of general provision, means the actual amount of consideration which is received. So if any person who transfer such a right in the project before the issue of certificate, then the benefit of such provision will not be applicable. The benefit of section 45 subsection 5A will not be applicable. Now we will discuss the meaning of certain terms. Number one is competent authority. What is the meaning of competent authority? The competent authority means the authority which is empowered. Competent authority means the authority which is empowered to prove the building plan. The authority which is empowered. The competent authority means the authority which is empowered to approve the building plan by or under any law for the time being in force, means the authority which is eligible to approve the building plan under any law for the time being in force. It will be known as competent authority. What is the meaning of stamp duty value? What is the meaning of the stamp duty value? The stamp duty value means the value which is adopted or assessed or reasonable by any authority of government. The value which is adopted, assessed or reasonable by the any authority of government for the purpose of payment of stamp duties. For the payment of stamp duty in the respect of such immovable property, then it will be known as stamp duty value. Is that the value which is assessed by the authority for the purpose of payment of stamp duty, then such value will be known as stamp duty value. Then the value of such immovable property will be known as stamp duty value. Stamp duty value. Individual and HUF entering into specified contract for the development of project. Now we will discuss such a provision, means such concept. Section 54 This is the subsection section 54 subsection 5a. Now we will discuss taxability of capital gain in the case of specific agreement. Means section 45 subsection 5a in the summarized form. When there is any individual or there is any HUF who is entered into a specified contract for the development of project, for the development of the project. Okay. Number one, is the individual or the HUF transferring his share in the project after the date of, means he is transferring the share in the project. He transfer the share of his project after the date of issue of completion certificate. After the issue of completion certificate, if yes, means as per such example, these 10 flats are issued, sorry, these 10 flats are transferred by Mr. A after the completion letter. If it is yes, then capital gain would be arise, then the capital gain will be taxable in the year, in which the certificate of the completion for the whole or for the part is issued by the competent authority. If they transfer, before the completion, before the issue of completion letter, then if the individual or the HUF transfer his share in the project on or before the date of certificate, then the capital gain shall be arise in the previous year in which the transfer taken place. If he transfer these flats, or if he transfer his share in the project before the issuance of completion certificate from the competent authority, then such a capital gain will be taxable. Then the capital gain will be taxable in the year in which a transfer taken place. If he if he transfer his right after the completion of, means after the issue of completion certificate, then the capital gain will be taxable in the year in which the completion certificate is received. Stamp duty value of his share on the date, the stamp duty value of his share on the date of issue of certificate of completion plus cash consideration is equal to a full value of consideration. The full value of consideration in the case of first point, when he transferred his share after the date of issue of completion certificate, in this situation the full value of consideration shall be the stamp duty value of the right, the stamp duty value of the share in this project plus cash consideration if any, and the full value of consideration deemed to be the cost of acquisition for determining the capital gain on subsequent sale of the share of the developed property. Is that if after the issue of completion certificate, if there is any sale of these share is made by the person, then the full value of consideration shall be deemed the cost of acquisition. Means the full value of consideration shall be considered the cost of acquisition when we will calculate the capital gain. When we will calculate the capital gain at a time of sale, then such full value of consideration, means stamp duty value of the share or sale consideration, we will consider as it a cost of acquisition, and the amount we will receive will be considered as full value of consideration or the sale consideration. So this is the summary of such concept. So on the basis of such discussion, we have discussed the charging section. Of capital gain. This is one of the important section because now we will discuss all those provisions in which there is a requirement to calculate capital gain and requirement to determine the taxability of the capital gain. When you don't know about when it will be taxable, means in which year it will be taxable, so how you will calculate the amount of capital gain which will be taxable in the current year, in the previous year, means the to know about the proper taxability. To know about the taxability, the concept of chargeability is very much important. On the basis of such concept, we have understand which amount of capital gain means the amount of capital gain when will be taxed. The amount of capital gain when it will be taxed. So we have covered such concept. We have covered such class, and there are some other important classes which are relating to such a concept. Kindly consider all the classes which are related to such concepts so that you can properly understand each and every concept of capital gain properly. Thank you so much for watching this video. Okay, bye bye and have a nice day.